welcome everybody. Thank you so much for joining us today in the latest Service Department News webinar, a very popular webinar, I have to say. Today we're going to be talking about hotel diversification into service departments and branded residences. My name's Eloise Hanson. I'm your host for today's webinar. When I'm not hosting webinars, I head up Service Department News. SAN is an online trade publication. We cover the global service department, apart hotel and extended stay industry. So The Residence is a kind sponsor of our webinar series. The company is a luxury service department operator here in London, and we have a short video to play for you today. More details about The Residence have been popped into the chat if you'd like to learn more. Muse is also sponsoring our Service Department News webinar series. Muse is a cloud-based hospitality management system. Its clients include hotels, apart hotels, service departments, and more, very in line with what we're going to be talking about today, how all the asset classes seem to be converging. So very apt. Again, more details on Muse have been popped into the chat if you would like to learn more. So let's meet our speakers for today. They can do a much better job of introducing themselves than I ever could. I'm going to kick off with ladies first. So Diane, over to you and welcome.
Hi everyone, thank you for asking me to be part of this gathering. So I'm Diane Daudin-Clavaud. I'm the corporate director for Nobu Hospitality. So I cover the development all over the world. So we Nobu, as you know, started 30 years ago as a restaurant, and then we evaluated around 2010ish to hotel, and 6 years ago we went to branded resi. So yes, that's I think now above 65 restaurants, 55 hotel, and 25 branded resi signed. So yeah, I'm looking forward to talk.
We've got lots to talk about today. I can say that with confidence. Peter, let's come to you next. Welcome.
Hi, so Peter Sugden, Clyde Co. I'm a mainstream investment, corporate real estate and hospitality lawyer. There isn't much I haven't done across the asset classes and upstream in terms of structuring. If you count the last, count 2 years as a trainee article clerk, I'm coming up on 40 years in the profession this year, and haven't I aged well? A lot of what I've been doing over the last 20 years is in the hospitality sector, and that obviously means that you then be taken into the service side and then into branded residences. And as Diane knows, myself and some colleagues have just acted for Solboy on the Manchester Tower that got announced last week, where Nobu are going to operate restaurant and hotel and brand 450 or 60 branded residences.
Yeah, it's a huge project. It's mammoth. So
huge for Manchester as well.
Yeah, no, looking forward to seeing that coming to life.
And I was born in Liverpool, I have to admit, but I don't mind. They can have it.
Thanks, Peter. Rick, let's come to you next. Welcome.
Well, thank you very much. I'm Rick Schultheis, Area Director of Sales for the UK, Ireland, and Nordics for Rotana Hotels and Resorts. We have 6 brands under our header, 84 hotels at the moment. Growing at the moment about 12 to 15 hotels per year. So hopefully by the end of this year, we're reaching the magical mark of 100 hotels. We mainly operate in the EMEA region. Have just moved into Asia with our first hotel in Pakistan, which will then extend into India and also into China. So yeah, it's a big brand with big plans. So looking forward to telling you all about it.
Thank you, Rick. And Alex, last but not least, over to you and welcome.
Thank you. Hi, I'm Alex Garrett, Managing Director of ProInvest in Europe. Pro-Invest is a vertically integrated investor in hospitality and living sectors. We have presence in Europe, the Middle East, and Asia. We have around 6,000 hotel bedrooms under operational management, most of which we have built ourselves through a series of funds and investment relationships. I think relevant to this discussion, we are making headways in both branded residences and flex living or co-living, both in Australasia and Europe at the moment.
Thank you, Alex. And I will flag here that all the LinkedIn profiles of our speakers are in the chat. I do encourage you all to connect because we've got lots to chat through today. There's probably lots more that we can discuss. So carry on the conversation long after today's webinar has finished. Brief overview of how today's session will run. I'll spend around 45 minutes in discussion with our panelists today, followed by some time at the end to take any questions. So please be quick and fast. If you would like to ask any questions, use the Q&A function at the bottom of your screens. I will get round to asking those wherever I can. And this webinar is being recorded, so everyone that has registered will receive a copy of that recording within 48 hours' time. So let's kick off with some context. I think it's always useful to understand what's been happening in the market. And here is some examples of recent activity from hotel brands with regards to branded resi and service departments. So first up, Rosewood has just opened its first standalone residences in Beverly Hills. Quite small, 17 residences, and Savills expects that standalone residential projects are expected to grow by about 4% over the next 5 years, so that will reach a maximum of about 12%. And talking of debut projects, Nobu signed its first resi project in the Netherlands. This is a mix of residences to purchase as well as serviced residences for extended stays. And this was closely followed by the Manchester site that Peter spoke about during his introduction. It's a huge project, third tallest building in the UK, 160 hotel rooms, 452 Nobu residences. And staying in the UK for a moment, this time in Glasgow, plans have just been updated for the first service department project that Radisson will operate in the country. A second public consultation on the project has been held about 2 weeks ago, and now a full planning application is expected. On the next slide, and to broaden the conversation and to speak more generally about the considerations for diversification, I want to kick off by highlighting revenue management and the complexities around revenue management when it comes to balancing long and short stay. Too many long stay bookings can limit revenue opportunities. Too many short stays can increase operational costs. So balancing that business mix is critical. It does present challenges, however, around accurate forecasting and pricing. You may want to partner with an extended stay booking platform, for instance, such as what Wyndham has done with My Room 24. And this partnership integrates Wyndham's entire global portfolio of hotels, including its extended stay hotel products, into My Room 24's booking technology, which will allow for stays ranging from 28 to 185 nights. And whilst we're seeing the hotel chains increase their presence in the extended stay market, activity is also happening the other direction too. So for instance, service department brand Your Apartment has recently partnered with Homes and Villas by Marriott Bonvoy, and this will allow Marriott Bonvoy members to earn and redeem points now across Your Apartment's portfolio. So these are all just to spark your curiosity, to get us excited for today's conversation. So let's talk about diversification. And I think it's wise to kick off by dissecting some of the trends that's actually underpinning the demand. I want to start with Diane, and then we'll bring Rick in too here. But Diane, what trends are you seeing as the primary drivers for this increased demand for extended stays, which includes branded resi, serviced resi, etc.?
Well, it's a large question, but I think consumer wants more from their travel now. Space, privacy, flexibility, sense of belonging, and I think also extended stays are now a little bit more aspirational. They're not just functional like before. So I think also that's explained the trends. Especially with the rise of like remote work, digitals. We see also that from our segment, we have a cross-generational demand. It's not only high net worth families, it's also Gen Z retires that believe in a brand and are drawn to a branded lifestyle offering after the years of work. I know you might like what is important to share, I think, is that the residents are often fully sold before the hotel is also opened. So it shows a brand power and a long-term demand. And I think it comes also from those criteria that I mentioned, and also that branded residences are they offer lifestyle alignment, whatever you like for any brand. But I think also they are perceived as a safe investment as well, which is exponentially valuable in times. So I think also that's one of the points. And I think that the people who are buying into a brand, they're not just buying bricks, but they're obviously buying an identity, a lifestyle. Sometimes there's certain services that they are buying as well. For us, I think it's also a very culinary focus. So I think all those I think now if you want to live, you have the income and you want to live in residences, having a brand managing it for you and having an asset that will probably take increase is that the right way to go. Mm-hmm. Especially when you can put it, for us at least, on a mixed use complex, which creates some cross sales and some fluidity between hotel residents that are rent to the pool of the hotel, residents that are lived at, and restaurants. So that creates like a certain hub of destination with different services.
Mm-hmm. We'll touch on location a bit later on, because branded residences you take Dubai, for instance, big urban city, but we're now starting to see remote or remoter destinations where branded residences have great success. Rick, let's bring you in here. You mentioned Rotana has 6 brands, some of which I believe are service department brands. You've got a residential brand too. What are you seeing as the trends that are driving demand for extended stays?
Yeah, I think especially for the Middle East, you see a huge demand in search for branded residences and extended stays. Like Diane already touched on, especially one of the ones is diversification of hospitality offerings. So it's definitely, they're looking now for a flexible accommodation options that are there. People look also at their branded lifestyle from how they're used to running their lives and what they would highly value in their lives. They're looking for those kind of branded either service departments or also residences to actually fit with that. If you look for especially for the Middle East, you've seen an increase of, especially in the GCC, of service departments with about 12% increase year on year until 2028. That's also the forecast going forward. Another one, of course, especially for my area in the Middle East, is the residencies. Of course, you've got countries like the UAE. They've introduced residency programs. So, for example, the Golden Visa, etc. So you have a lot of global residents that are seeking long-term stays with favorable benefits, and that are what the countries that I look after are offering. So I think those two are really two main drivers for people to move in, for example, the Middle East, where we are situated.
Who's your typical like demographic, Rick? Who's actually using the products?
It's a wide range, to be fair. It's of course we also have a lot of our properties are linked, or our Arjan is our service department properties. They're linked to a Rotana hotel, which is a 5-star. So it could literally be your expats, your corporate companies that are looking for somebody to even be there for 3 months, and then they will go into permanent housing, or sometimes also just for a whole year, either stay in our residences or in the service departments. But it's from corporates to leisure. You also see more and more people that actually are choosing a service department as a leisure destination for sometimes even only for 14 days until 28 days, depending how long they would want to be there. So it's very diverse. You used to be able to say it's just corporate, not anymore. It can be literally from any kind of segment.
Mm-hmm. This is why I wanted to bring up or touch on revenue management at the top end, because there is now an increased complexity around trying to balance that short stay leisure with your corporate longer stay too. Alex, I'd like to bring you in here because Diane touched on the brand power, and she actually mentioned that the residences sell quite quickly or long before the hotel actually opened. So I'm going to dive straight in here. What is the value of a brand to an investor, and how do you actually assess what premium that brand can drive?
I guess I will start, and sadly not that controversial statement, but saying that I think the brands do add tremendous value, particularly in the area where I'm focused on, which is in branded residences, and it is perhaps more in the leisure resort, non-urban destinations. And I think in that scenario, I think the brands can really help create an identity for a project, which otherwise you would have to backfill with a huge amount of marketing, but it creates an immediate identity, which can be helpful. It can also work to your hindrance, and what it means is you have to really think very, very carefully about the brand that you're selecting, who their customer is, what they stand for to the customer. So I think that's definitely one area. I think brands do create a kind of halo of trust around the project. And I think intuitively, the customer assumes that if it is a recognizable, trusted brand, then the project's probably going to be delivered. The project's probably going to be of a certain standard and quality. And I think what that also does, which I think is quite compelling, is it gives perhaps a bit of bravery or a bit of freedom for people to go to destinations that they probably wouldn't have had on the top of their list ordinarily. And so they can go a little bit more off the beaten track. So, I think the brands do add a lot of value in the area that we are focused. I think they also bring a lot of collective knowledge around design and particularly resort programming. And, that is a huge part of the success of a project is getting that right. If I was trying to put a figure on it, and this is kind of anecdotally based upon my experiences, I think we've seen in London at projects we've been looking at that we've seen a strong brand deliver a premium in the region of 10 to 15% over prime residential in that market. I think in resort leisure destinations, we're seeing exponential increases of that. So, 60 to 100% premium versus the local market comps.
Thanks, Alex. Peter, let's bring you in here and let's talk about the regulatory challenges. And I don't want to be controversial, but I sometimes maybe working with a brand can be challenging at times. But what are the regulatory challenges that hotel brands face when they are looking to expand into residential?
Well, obviously, many countries have local law nuances around planning, construction, residential, occupation, operation. I think for the UK, the key challenges you see at the moment: planning use, service charge costs, and general residential building management. It's coming up. It technically exists, but it's coming up potentially with the renters reform bill that you could find yourself in with a bit of a jam with anyone who won't move out, depending on how you're operating, and of course the dreaded Building Safety Act. So planning challenges tend to be around how you're operating. At one end, you've got a hotel, which is quite clear, which is C1, and the other end, you've got residential, which is C3. In between, you get various areas of grey, which is at one end, apart hotels, flowing through various types of serviced operations, and they can fall into one or the other. They can be sui generis. So you might say some of the Eden brands are a bit more apart hotel. You might say a Portland Brown type operation is very residential, and you just take it the branded residences are pure residential. So we're talking the serviced, if you like, side. You've got people in between, say Cheval, who will do both things, and famously on their, I think the one at Tower Bridge had split planning consent to try and manage that. It is a problem, planning, and you've got ASAP, the Association of Service Apartment Providers, who've been lobbying to try and get some clarity. It is a problem, and it's a problem for operators because they don't quite, it depends where their business is coming from. It's also a problem for planners because they can be put in the situation of having to either enforce or turn a blind eye. And of course, what they want is beds and commerce, and so the current situation isn't helpful. Residential property management, I think the challenges there around, for the branded side, you've got an inherent tension between the branded residences need to maintain brand standards. That's what they're selling. That's the enhancement of value that Alex flagged. As against, you've got some controls around the service charges, particularly, and expenditure. And so you've got to navigate your way through and avoid that conflict where a landlord owner can be caught in the middle. And whilst it's quite too complex to go into too much detail here, I would just cryptically say that vagueness is your friend in this situation with branded residences, which is often not the case for landlord. Sorry, vagueness is not your friend. It's the other way around. Sorry, I'm being stupid. Precision is your friend, not vagueness. So, then occupier. This renters reform bill, of course, it's got a lot of debate going on around it. But I think whilst it's been largely ignored at a practical level in recent times, some of these changes could inadvertently stray on to certain types of service department operations. I think that what you need to do is be sure how you're operating, what your planning is, and what your T's and C's are saying. Mm-hmm. So I think people need to examine the T's and C's in a way they haven't worried about before. Mm-hmm. Building safety, well, whole new area of challenge. Does it apply to hotels? Apparently not. Does it apply to a residential? Oh, yes, definitely. But when's a hotel not a hotel and it's more residential? There's a whole other debate we could spend a lot of time on. I think that's probably headline stuff for these purposes.
And when it comes to things such as planning or further afield, maybe other sort of regulatory policies, does this differ when you're looking at independent players? For instance, maybe a non-hospitality brand that's maybe moving into the sector, or is it just a...
No, I don't think so. It's if it's planning, it's all about how you're using it. If it's about building safety, it's, well, what exactly are you doing? So no, I don't think so. I think the issues are all the same.
Okay. Alex, I want to bring you back in to go back to the power of a brand, and the role that independent operators may play in the next 5 or so years. What does that look like to you?
So I may kind of switch hats here from branded resi perhaps over to kind of flex living, where I think this is for us a little bit more poignant. And I think certainly for nascent living sectors, there is a lot of value in having an integrated ownership and operation, especially when you're scaling a platform. And certainly when ProInvest has done that over multiple decades now, we have always tried to internalize as many of the functions as we can as we're scaling a platform, because that gives you speed to react to environments, that gives you flexibility, control, adaptability, and really the ability to optimize the operations of that platform. And then when you come to exit, it gives you optionality as well, and those can all be pretty valuable. But I think as we've seen in the hotel sector, as it becomes more established, there really can be a benefit to economies of scale beyond what you could achieve with a single platform. Concentration of expertise and specialization. And I think perhaps the other thing is, as a sector becomes more established and the investor pool widens out, there's a number of investors who are going to want to own the asset, but not necessarily have to deal with the complexity of operations. And so, I guess there is an interesting question about, of each of the living sectors, what stage they're at, and at what point they would really benefit from having a sort of white label operator coming in and scooping up some of the operations there.
Mm-hmm.
But yeah, I think that's our view.
Thanks, Alex. I want to dwell on the operations for a moment to perhaps drill down into performance. So I want to bring Rick back in here to sort of look at the brands and how the different brands by product, say hotels versus service departments versus residences, compare. So what are the key differences in that performance when you are looking at Rotana's brand portfolio?
Yeah, so if we look at Rotana, so key differences in performance, what we usually look for is one target customer segments, for example, market dynamics, operational costs, and also of course the financial performance for each hotel, apartment, and residences will have quite different customer needs and also varying operational costs. So if you look at the first one, for example, apartments, they attract more corporate clients, tourists that like extended stays. So their performance is usually a little bit more dependent on monthly rental rates, occupancy, and also customer loyalty. We see that a lot there. Residences, a little bit less, more expats, your families that are coming there looking for more permanent kind of accommodation. And there, for example, for us also rental incomes are more stable, although still more flexible than, less flexible than with the hotels and service apartments that we have. And touching on what you said in the beginning, of course, revenue model. Revenue is always one of the higher ones. Again, there are also apartments, less flexible in pricing compared to hotels. Residences, again, predictable cash flow you have there, so it's a little bit better, but also limited variability in your pricing. We always look at occupancy and then the pricing trends. Again, there for apartments, we usually look also at location, demand for the long-term stays, and definitely also competition in your areas. And for residences, it's a bit more what the real estate market trends are, and it really is a bit sensitive to oversupply or the demand in the regions that we have. And then, like I said, fourth one, operational cost, profit margins. Typically for apartments, there's a little bit of a lower operational cost because they don't always require the daily service that you see in hotels. Amenities that will be offered usually in hotels. Although these days on the sustainability, of course, we're also cost cutting there a little bit more. But in apartments, usually apartments get cleaned either twice a week, etc. So less cost there. Of course, the lowest operating costs are in the residences there. So it's yeah, the only costs which are a little bit higher are maintenance and management of the residence itself. So if you look at that, metrics that we usually use are pretty similar if you are looking at hotels, service apartments, or residences. Of course, it goes always occupancy, always the most important. I think, especially if you look at the Middle East, the bigger kind of cities, like we mentioned, Abu Dhabi, Dubai, Riyadh, very up and coming in the Middle East at the moment. High occupancies, and you can really see the similar kind of developments that you see in Europe and the European cities there. Again, also average daily rate, the ADR, very much a metric for us, and still and always will be. Then one from the old one, the revenue per available room. Again, also there, still competitive for all three segments. Then we come more to length of stay. It's critical, especially for apartments and residences. It really will show generally the more profits will be made in certain kind of asset types. We look at rental yield, especially for residences and serviced apartments. And last but not least, operating profits. I mean, that's what everybody does it for. So also for us, really to see what the operating expenses are deducted, and see what we net have in our pockets for those areas.
Mm-hmm. And when it comes to you highlighted, I think it was Pakistan you mentioned as a market where you're moving into. How are you looking at development when it comes to placing the right product in the right location? So let's take Pakistan. Is this hotel, serviced apartment, resi? Where does the product sit within your expansion plans when it comes to geographies?
So it will really be a good market research will be done first for the particular cities that are needed. We also turn this around a little bit more. So we actually look where the client demand is. So we actually go out to our clients that we currently already have with Rotana and seeing what are they missing and where. So what we also really ask is which kind of cities are they seeing where their particular projects will go. In the Middle East, it's a lot of project work, and you will see that across the oil and gas, finance, etc. So we actually will look a little bit more from what fits best with the client needs in that particular kind of area. For Pakistan, it was a hotel. So we have a hotel there. And for example, we're looking at London to open something there in southwest London, which is still an area which is relatively untouched for these kind of things. And there we're doing our first kind of cooperation to have a hotel and the serviced apartments in one building. So again, they're looking at the area of London, what's needed in that particular area, looking at the next 5 years and 10 years. And then, moving that product in that particular kind of area of the world, or in this particular case, London.
I'm at the I mentioned in our sort of green room before this webinar, I'm at the GSER focus group today, GSER, the Global Service Department Industry Report. And it's certainly come out that when it comes to serviced apartments and the lack of data that is in the market right now in order to make the right decision when it comes to entering a new market, and how does one build the comp set accurately in order to inform that decision making? It's difficult.
Yeah, I think also you see also a lot, because a lot of companies are looking and they're going away from the traditional hotel stays, even if they were sometimes 1 or 2 weeks there. And therefore also because there's now so wide of a choice, and brands like Hilton, Intercontinental, they have like 30 different kind of brands, and sometimes people also don't what's the difference between a certain brand or a certain level that they have. I think that's where that comes in, that it's sometimes very difficult. What does the client want? And sometimes even you could say, even does the client know exactly what they would want until they've experienced it? So I think that's also, it's in general a very fast moving segment, long stay and serviced apartments. I think that's where you probably sometimes will find that not all the information is available that you would like to have. So definitely something, to work on.
I'd also just add that I remember talking to James Foyce and Peter Lowy about 18 months, 2 years ago. They're ASAP, James Voice runs ASAP, and their lobbying, one of their real challenges was I think we were both at their conference about 2 years ago, Eloise, and one of their key challenges is not having enough data to provide to ministers when they were lobbying to prove the size of the market, so that they could try and get them to take seriously the necessity for change in things like planning.
Diane, I could see you were nodding along as we were talking there. Could you I mean, feel free to chime in with your own thoughts here, but I'm going straight in with a question around how performance metrics such as average length of stay, RevPAR, etc., how does that influence your development strategy?
Well, there are key pillars when we evaluate the viability of a branded residence or an extended stay product. At Nobu, we see the extended stay and the branded residences not just as a product type, but also as a lifestyle choice. We see strong indicators of that our guest intent is to stay longer, and that signal for us a desire of more connection, comfort, belonging to the brand, being able to appreciate, the services that we offer. So they are key pillars. We also now, I think they shift also how we design our space and services. From like with different branded residences that we are going with. So we have signature dining, wellness. So we created a brand called Nobu Pilates. So that also is I think quite appealing for a lot of our segment that are in the sport lifestyle. Curated experience with different omakase and forehands. You can also on branded residences, the way we design also, at least for the more consequent apartments, we are very careful on the way we design the kitchens. So the idea is that the purchase, you can basically have a chef from the restaurant that comes to cook for him and his friends. So you basically have the culinary experience and the experience of the restaurant, but you do have it in a way of more private way at your residence. All those are not secondary. I think they are fundamental on for us, to also achieve all, those premiums that we are achieving, because they buy into the brand. They just they don't want just square meter or square footage. They're buying a meaningful place which has soul and which has for us a very important culinary component. I think that there are definitely key pillars, and I think before you asked me about geographically where we are looking at, right?
Yes, please do.
So that would be so the first like straight answer would be where my customer wants to go. I have 7 million customers, and they also decide also where I expand. But obviously location is very important. And also the second criteria here would be my investors. Where do they want to invest? Because in Nobu, as you know, we are asset light, but we have investors that we have 7 billion invested in asset management to our investors. So they would be defining where I go. But that being said, I look at destination with a very high demand urban market. That's still very predominant in my search. London, Dubai, Tokyo, you know, if I want to take the spectrum of the world. Also secondary market, like you mentioned Manchester. I think it's cities like also Lisbon, where I am today, where the sensitivity or the cultural, how to say it, vibrancy is high. So I think that are also a great location for us to look at. And the last one would be like leisure-led destination, like, you know, I'm looking a lot at Indonesia and Mediterranean, like I think also we have a beautiful branded resi at in Los Cabos as well. So I would be looking also obviously in resorts and as property types perspective, I would say that I'm more focusing on integrated developments, such as, you know, blend branded residences with the hotel, the lifestyle offering. I say this and I just you notify that I had just signed Amsterdam, which is a standalone. So I'm also going that direction. But the direction is when I believe that it might be a bit too hectic to have a hotel in the city when there is a limited offer in the city. And I feel that it's a city that is maybe too concentrated in traffic. So I just feel that it's better to be in more, maybe in a more wealthy area where I will have my bread in resi and I will have a very, very strong restaurant and spa, green areas. So that's also a direction we go, but still the integrated development is my main focus. And I think that those hybrid models are really gaining traction. Not only, you know, as a hotel and branded resi, also, you know, in wellness, work from anywhere. So in Amsterdam, we're going to have a very strong workplace. You know, so you have a facility that will be built in Krakow that I've signed as well. You know, we will have a very good entertainment hub or festival hub, or like it's like a big, you know, cinemas and retail. So this is a direction that we're going with as well. And the branded resis that are pulled back to the hotel and the private residents actually coexist. We try to avoid to put them in the same tower, obviously, because it's not the same atmosphere, but they coexist. So they really bring area to life, and there's really that's a quite deep brand immersion, and you can have well, you can have your privacy, but also still the appeal of the brand that some owners really cherish. So that's basically where we try to that's what will basically stream and influence my expansion.
It's interesting you mentioned the sort of the separation between the two, in that it must have been a few years ago, Ian Schrager was talking about what he coined mini Miamis, and this is the idea that you can build a lifestyle product in one tower. So that has your residences, extended stay, your leisure stay hotel with your entertainment hub or co-working all in one building. Brings me on to my next point with Peter, because often when we talk about serviced apartments or branded residences, they are attached to a hotel. So if there is a hotelier, for instance, that's looking at expanding into serviced apartments or branded residences, how would you define, from a legal perspective, Peter, a serviced apartment versus branded resi?
Well, it's actually pretty fundamentally simple. You're either owning those apartments, which would otherwise be the branded residences, or you're not. If you own them, you're on proper branded residences. If you're staying, even if you're staying in them for 9 months or something, then they're serviced apartments. What you can get out of say, the adjoining hotel in terms of services or what you get inherently occupying them. It's really whatever you write it to be for your customer. So if you've sold a long lease for a branded residence, you can, it's totally optional, really. It's yours. If you're Nobu, if offering an a la carte menu of services from cleaning to food to concierge type stuff, whatever, it's entirely your choice to take that. Equally, if you're in a service department, you're going to be in and out. You're going to need some cleaning going on. Some of that's more built in. I don't know, actually, Diane. Can your branded residence owners live in a mess if they want? Is that entirely up to them not to ever clean them?
If they rent it, no.
No. If it's sold, I assume so. I assume they don't.
And
because you can't
if it's
force
sold,
them
they
to
have the
clean.
choice anyway. They have the choice to
Yeah, you can't force them to clean.
to either have our furniture or not. But then if they don't, they basically then will not be part of the pool as a rental
Yes.
pool.
Well, of course they wouldn't. You wouldn't rent their flats for them. Yeah. So I think it's, the fundamental differences there. But in terms of services, they're all services. They all. It's really about what it is you're creating and selling, either from a capital sales perspective or a rental sales perspective. It's what you create. It's all a sales angle.
I recently wrote in the latest service department newsletter about the opportunities for service department operators to explore the branded resi market. And my argument was that from a rental perspective, you should be able to scale and build on that infrastructure. But it was my argument was that on the amenities and on the services, if service departments are typically quite lean and maybe limited service, then there are further considerations that would need to be included if you're exploring a branded resi product. So with that in mind, Peter, like how could a service department operator look to adapt their services, as you highlighted, and rental agreements to meet the demands of what that branded resi product and clients are looking for?
Well, contractually, a services agreement is a services agreement. I shouldn't say it, but there's nothing that clever about it. It's a contract. It's a contract. The basics of the contract are all pretty much the same. The services are different, and the services come from what you're doing, how you're trying to sell and make money out of it. A service department, I guess in theory, a service department, take a luxury one that mentioned they were looking at this that I won't name. Not it was told me in confidence, but a luxury service department provider looking at doing branded residences. As long as their apartments are suitable to sell on a 999-year lease, it's just about how they capitalize that particular building. So either they're owning those apartments and they're renting them, or somebody else is owning them, and they may still be renting them because, as Diane mentioned, a lot of these branded residences, they have a rental program, so you can put your apartment back into the rental program and it gets rented for you. So I think you could probably see it as partly as how you're capitalizing a particular development. The services then just have to fit your ability to sell. And the one thing that I have not really come across much or read even much about yet, and I'll be interested if any of the other guys have knowledge on this, I guess particularly Alex, is below luxury level branded residences. I do understand that that's starting to develop. So it's sub-luxury, but it's still branded and it's still being sold on a long-term basis. So I don't know the answer to that, but structuring it, actually, really nothing clever. Just where you're putting the money in, where's the capital going, and who's providing that capital.
Alex, do you want to come in on the sort of the sub-luxury point? I mean, I'm seeing a lot of like in the lifestyle hotel space, 25 hours, mama shelter. Typically, they fall under the Ennismore brand, right? But they're looking at a branded residences. There's a independent operator, or not independent, but Rove Hotels in Dubai. They're also looking at building a standalone branded residence project, which is more sort of 4-star offering. Are you seeing similar movements?
Yeah, I mean, I've been observing from afar. I wouldn't say it's been a big area of focus for us. I guess the part that I am struggling to reconcile is if you are if some of the drivers for luxury branded resi is the exponential growth of high net worth and ultra high net worth, and the disposable capital to have a vacational home, second home, third home, fourth, fifth, whatever it may be. I can see how luxury branded resi falls into the domain of what they may like to spend money in. I think as you move down the tiers, it becomes less about a vacational home and perhaps more about a primary home, and that may lend more to dense urban environments. But I think it is still the same desire to have experiences, to be part of authentic communities. And so I can see there's a lot of common drivers for the demand for that, but perhaps it's being used in a slightly different way than how we're looking at the sort of luxury branded resi market, which again is more kind of second home ownership or multi-home ownership in beautiful sort of leisure destinations.
And staying with you, Alex, to broaden or to talk about the extended stay sector quite broadly, where do you think is the most attractive investment opportunity?
I will very quickly gloss over branded resi just because we've been talking about it and this hasn't really been discussed or framed in this context. But from an investor's perspective, and we've talked about some of the drivers for demand, but from an investor's perspective, what is attractive is you get accelerated recycling of capital from the residential sales, and if what we're saying is correct, potentially at a premium. So that's obviously quite compelling. From a hotelier's perspective, you get residences coming back into your inventory, which you can then sell by the night, by the week, or by the month, and that's great. And then you also you get quite a lot of facilities and that kind of get thrown in that you can sell, which are over-specced because of the residential customers. So from a hotelier's perspective, that is quite compelling. From a customer's perspective, you have a more generous facility and you have this vibrant community because people are there for different reasons and in different periods of time. And so really from an investor's perspective, if all goes to plan, which it doesn't always, but if all goes to plan, you should have diversified income streams and superior returns versus a traditional hotel development, for example. So that's really a lot of the reason why we're very focused on the area. But I also would like to comment on this kind of flex living and actually what's really caught our attention. And perhaps it's at the other end of the telescope from a consumer perspective, but where we're focused on flex living is around retrofitting of existing buildings. I think typically this is urban locations. The occupants are there for typically 3 to 9 months at a time. What we have sort of found is the opportunity here has manifested itself differently in different locations. So what we're finding in our Australia business is actually we're finding in residential locations where there are hotels which don't really have a true place in that environment, we're able to convert hotels into a kind of flex living type concept. And that's working really well in that environment. In London, by contrast, where hotels are shooting the lights out for the most part, We're focused, as many other people are, on kind of C-grade office in good residential locations, but probably less obvious office destinations in today's environment, and converting and retrofitting those to kind of flex living use. And as we dig into this sector a little bit more, I think what we are finding quite compelling is we started off with the thesis that this is students who are looking for their first job and are looking for, cheap and efficient digs and want frictionless kind of, residential experience. Actually, what we're finding is that the demographic and the user profile is far wider than we expected. And, you could have people where it's their first job, you could have people where they've moved overseas, you could have people who, couples that have just got together, you could have individuals who have just got divorced, you could have, people who are looking to downsize. And so actually we're finding that user profile is much wider, and we have a lot of conviction around the demand for the product. Obviously, the challenge that we're facing, and as are many others, is how do we navigate the planning regime in places like London, but not uniquely London.
To dwell quickly, so we're running out of time, but to dwell quickly on the user profile there, Alex, do you see branded resi going into retirement homes, or filling the need for a senior living user profile?
Yeah, I mean, it's funny. It's something we have been talking about internally as an iteration and a niche either of co-living or a branded residential. And I think we've seen a couple of people start to do it on a sort of single or 1, 2, or 3 unit sort of level. I think it is susceptible to the same challenges as all of these, which is how do you find the right location to deliver the right product at the right cost with the right sort of local government body support. But intuitively, yes, and I think we are starting to see some pretty interesting niches coming out of branded residential, extended stay, and flex living.
Thanks, Alex. I just want to finish up with a question to Rick, because you've been sat there rather patiently. So I'm going to give the final question to you. What strategies should hotel companies use to optimize their extended stay offerings?
Yeah, I would think definitely look at enhanced flexibility and personalize. Look at tailor-made packages that you can offer, discounts, etc. Customized services. So more flexible housekeeping schedules, also additional services, say for example, grocery deliveries, laundry services, etc. That will be a big thing and really push that forward. Also create home-like experience. More and more people are looking for the kitchenettes, full kitchens, high quality kitchen appliances, etc. That will really help comfortable furnishing. That will be a good thing. Lately, what we really get a lot of questions about, and it's not that new, but still offer community and networking opportunities. So it's coming a little bit back again, and maybe after COVID, it says comes back again that people do want to meet face to face, and also if they're living in these kind of serviced apartments, just to meet somewhere either in a communal area, sort of a happy hour, barbecues, those kind of things, those kind of setups. Of course, it's never going to go away. Digital and remote solutions, so more like the check-in, check-out, keyless entries. We're seeing that also more, looking at that for Rotana, for example, in our own London property, to make that totally seamless and totally digital. And last but not least, I think also health and wellness, because if people, of course, staying for a longer time in these apartments and residences, they really want something that's either on-site, but also outside. So look at partnerships with, for example, outdoor activities, with other services that are in the area, but also in local services that are there. I think those are like the 6 kind of items that I really would say focus on those for the future, and you'll get there very easily.
Thank you, Rick. I'm just going to flag here that we are going to keep this webinar open just at the end to play a short video to allow our audience members to follow up on any of the links that we've popped into the chat today. Again, the Our speaker LinkedIn profiles are in that chat. I can see that we've got some questions coming in now, but we don't have time to get through them all. So please connect, carry on this conversation. I'll say a quick thank you to Diane, to Alex, to Peter and Rick for their time and insights. I've just got some closing slides that I would like to run through before I say a final goodbye. Our next webinar is taking place on April the 24th. We're going to be looking at industry rising stars. We're going to be placing the focus on those young professionals, even old professionals perhaps, who have a promising career ahead of them. So please do join us. The link to register has been popped into the chat. And there are 4 working days left to enter this year's Service Department Awards. We've introduced a brand new category this year. It is for the best hotel with service departments or branded residences. So it's these awards are no cost to enter. We have 19 categories that you can browse and apply for. So do get your entries in. The deadline is the 2nd of April next week. And if you're interested in working with us, either across our digital events such as this webinar or perhaps our Service Department Awards, which is taking place on the 13th of May here in London, do get in touch with my colleague Katie. Her details are up on your screens and it's also been popped into the chat. So once again, thank you for tuning in. Thanks again to our fabulous speakers and huge thanks to our sponsors, the Residents and Muse. So hope you've enjoyed today. I certainly have, and I look forward to seeing you all sometime soon, most likely on the next Service Department News webinar. So take care, everyone, and have a jolly good day.
Hello, we are International Hospitality Media, or IHM for short. IHM is the #1 brand to engage with decision makers in hospitality and real estate. Our 4 multimedia brands lead their respective sectors with breaking news, comments, trends and opinions across a variety of multimedia solutions. We provide an inspirational community to connect people through world-class events, webinars, podcasts, award schemes and much more. But let us share our story of who we are and what we do. Over 10 years ago, Piers and George had a light bulb moment to provide expert opinion, comments and low-cost digital content. And so, they went on a journey over the past decade, creating media platforms to serve the hospitality and real estate industries. We now have an engaged audience with a reach of over 60,000 monthly visitors across our website, 52,500 in our email database across all sectors, and over 68,000 across our social channels. Everything we do challenges the status quo. We believe in thinking differently. We make things simple and very easy to work with us, and we're a friendly bunch too. We offer creative solutions to help you achieve your business goals. Read, watch, listen, and meet with IHM. Connect with us for a chat today. Just look at some of the brands we have worked with recently.